Welcome to Investors Guide. You're watching ET Now. Did you look at that? The channel turned 5 years old this week, which means this show is also 5 years old. We spent the last 5 years giving you financial advice and helping you move through the markets and make money over the long term. I'd like to first of all thank you for sending in all of those emails and tweets over the last week. It was such a pleasure to hear from you. And if you haven't sent us your message yet, if you've benefited at all from the advice you got on the show, record your success story on a video and email it to us. You can also send it to me on Twitter or you can upload it on our Facebook page. We'll be so glad to hear from you. This is a special show for us, and if you remember, in June 2009 when we started this show, we designed portfolios for different age groups. So we designed a portfolio for 25, 35, 45, 55, 65-year-olds. On the show this week, we're going to review each of those portfolios. We'll take a look at how they've performed and how they've done over the last 5 years. And in order to do that, I have to first invite Narendra, the architect of those portfolios. Narendra, thank you so much for joining us.
You.
It has, of course, been 5 years, and we've been managing these portfolios for the last 5 years. Has it been a daunting task to prove the advice that we give is actually worth its salt?
Oh, thank you very much. And it has been very frustrating, and now looks like, satisfying experience. At the same time, our ability or the way it was designed and constructed, we have made very few changes in these 5 years. And it has been, we have been able to withstand the test of time. Of course, it's not in a very long time, but still we have been able to stick to our principles, and that has worked. And we have been able to navigate through the ups and downs of the market. These 5 years have been a reasonably full market cycle, and so it's just a validation of our thought process, and we feel pleased about it.
All right, so what we're going to do on the show right now is we're going to go through each of these portfolios. Now remember, we started these portfolios in June 2009 on the assumption that we'd be investing 10,000 rupees every month in an SIP that has not been stopped for the last 5 years at all, which means that right now we're looking at a total invested corpus of about 6 lakh rupees. We'll start portfolio by portfolio and take you through them. First of all, the first one that we're looking at is our aggressive portfolio. This is a portfolio that was designed for a 25-year-old, assuming, of course, that you have your entire working life ahead of you and that is your time horizon. So we're looking at someone who has at least 30 years of investment in front of them, and the total amount invested is about 6 lakh rupees. The current market value of that portfolio, the 6 lakh rupees, has grown to 8.86 lakh rupees, with a total profit of a little over 3 lakh rupees. That's a return of 17.38%. I'm going to give you a list of the funds that we have in this portfolio. 10% in the DSP BlackRock short-term fund. That is the allocation to debt. There's IDFC Premier Equity Plan A, Quantum Long-Term Equity, SBI Magnum Emerging Business, UTI Opportunities. Narendra, are you happy with how the aggressive portfolio has done in the last 5 years? Because remember, when we started this show in 2009, we said long-term is 5 years or more. Now we've completed those 5 years of long-term. Is this how you hoped the fund would, the portfolio would play out?
No, I did not expect it to play out, or all the returns that we see right now has been generated in the last 5-6 months. So in that sense, the fact that this portfolio was always diversified, we stuck to our allocation. There was no need to change our positions, and most of the funds, we were still convinced. We are still convinced to hold them. Of course, we would tactically like to change some of our position, but I'm very pleased with these returns. 17%, 18% return in a period when the market has gone nowhere or virtually nowhere. Only in the last 2-3 months we have seen the momentum. I think it's a reward of an investor's patience or discipline of continually investing.
Well, Narendra, you have decided to make some changes in this portfolio as of today. Could you tell us what those changes are and why you're making them right now, if you believe that these are funds that we should hold on to?
I'm looking at, 2-3 principles which I'll follow in aggressive portfolio. One is a very limited or a very small fixed income allocation, but it should be continually rebalanced. Have about 40 to 50% into mid and small cap, and that too entrusted to a very high quality, into a high quality portfolio and entrusted to a skillful hand. And that is where, the selectivity comes into play. So that is what I have tried to do. Though initially the principle was the same, but my mid and small cap allocation in this portfolio, I was trying to keep it lower than 40%.
But I want to ask you about the two funds that you've added to this portfolio. There's the Franklin India Smaller Companies Fund and the ICICI Prudential Value Discovery Fund. Now, of their entire categories, tell us why you've picked these two funds to add to this portfolio.
These two funds qualify simply because of their quality orientation. One is, Franklin Smaller Companies Fund has proved to be one of the best performing one. I don't find an unknown name. I'm not scared of, it is unlikely that this fund will be stuck with any large position in relatively illiquid position. The other fund, ICICI Prudential Value Discovery Fund, I like this fund simply because it has stuck to its approach that it will be, building a portfolio with out of favor or undervalued companies. Tactically, for the next 1-2 years, it could be quite opportune because, the way the market has gone up, there is a segment of the market which is very attractive, which is very pricey. Yet, investors are buying it, and portfolios are filled with such stock. I think that this is a portfolio of cheap stock, and today finding such a portfolio is not easy.
All right. So finally, this is our aggressive growth portfolio. Remember, we're doing this to illustrate the principles of investing that we talk about, that you have to use an SIP, you have to invest regularly. Don't stop your SIPs when the times are bad. And there's no reason to have more than 5 or 6 funds in your portfolio. This is a portfolio as it looks like now after the changes that Narendra just made. There's a DSP BlackRock Short-Term Fund, Franklin India Small Companies, ICICI Prudential Value Discovery, an IDFC Premier Equity Plan, and the Quantum Long-Term Equity Plan. All right. If you have any questions about that portfolio, write to us. Email ID is on your screen right now. Let's move on now to our growth portfolio. Again, we've been investing 10,000 rupees in this portfolio every month from June 2009. Total amount invested is about 6 lakh rupees. Current market value is a little over 9 lakh rupees. So we've made a profit of nearly 17% every year over this portfolio. I'll give you a list of the funds in the portfolio. There's the FT India Dynamic PE Ratio Fund of Funds, ICICI Prudential Discovery, Quantum Long-Term Equity, Templeton India Equity Income, and UTI Equity. Virendra, same question. Are you happy with the way the growth portfolio has played out? It's designed for someone who's about 35 years old, which means that their aggression would have come down a little bit. But are these the returns that we were hoping for?
Given that, it has been such a low maintenance portfolio, we filled this portfolio with 5 funds in a defined proportion. And that too, the fixed income allocation was done through a fund which will change its color over time depending on the state of the market. So in that sense, it has been extremely satisfying. It is a passive portfolio where somebody has kept investing this money and has earned 17%, which is twice as much as, what you earn in post office MIP.
That portfolio is on your screen right now. Narendra, you have chosen to change the allocation a little bit, but when someone is investing in this portfolio right now, what would you like them to keep in mind? Should they keep in mind the fact that this is a market that's going to run away from us, which means that you shouldn't change the allocation to anything. You should make sure that you continue investing in SIPs exactly the way we did over the last 5 years?
Following these portfolios is all about a disciplined approach to investing. And the moment you try and, fiddle with that, you don't know where to stop. And when you don't know where to stop, then you are likely to go in the wrong direction. So, I think investors should resist the temptation. This is a very well constructed portfolio. It is high on diversity. It is high on consistent allocation. And, even at the cost, and it is very high on tax efficiency. If you look at, our aggressive portfolio or the growth portfolio, all the returns that you generate is virtually tax-free, only, 10 or 15% of your money, where you, even on indexing the returns of the fixed income fund, the tax incidence will be 0. So, 17% tax-free compared to, 8.5% taxable from a post office recurring deposit or a bank recurring deposit. I think the choice is clear, and that is one should keep in mind that the last 5 years has not been the finest years for the stock market.
That's true. So I'm going to go over our growth portfolio one more time. Remember, if you have a question about this portfolio, write to us. Email ID is on your screen. There's the FT India Dynamic PE Ratio Fund of Funds, ICICI Prudential Discovery, Quantum Long-Term Equity, Templeton India Equity Income, and UTI Equity. 17% tax-free returns over the last 5 years. That beats any sort of fixed deposit or post office savings scheme or the PPF, if that's what you prefer, designed for a 35-year-old. Let's move on to another portfolio. This is an international portfolio. This one is not as old as the rest of our portfolios. It's a couple of years old. We've invested about 3 lakh rupees in this portfolio so far. It's made a profit of 92,000 rupees. Narendra, the question that a lot of our viewers are asking us right now is, when we designed the international portfolio, the rupee was weakening. That has turned around. Now, of course, India is performing better than a lot of the other markets in the West. Does it still make sense to invest in this portfolio despite the returns it's given us so far?
Yes, absolutely. And I think investors should, do well to articulate it a little better, in a sense that if you have that international portfolio and if that happens to be 15 or 20% of your total equity allocation, then you must stick to it, because this is actually, presenting an opportunity. You are buying it cheap once again. The other is that gaining international diversification should be a key goal. India will do well, and that is why it should be a substantial part of your portfolio. And till the interest rate differential prevails in the developed market and our market, we are a one-way street. In the interim, there is a possibility that our currency might appreciate, but over a long period of time, it depreciates, and that is likely to continue. And I would say that investors should not change track, should not get distracted by the currency movement right now.
I will give you a recap of the international portfolio as it stands right now. There's the Birla Sun Life International Equity Plan A in 25% allocation, Motilal Oswal Most Shares Nasdaq 100, the Principal Global Opportunities, and the Sundaram Global Advantage. These 4 funds make up our international portfolio. We're going to take a very quick break, but when we come back, Narendra is going to stay with us. We'll talk about stable growth and conservative portfolio as we near retirement. This is designed for someone who's 45 or 55 years old, respectively, so don't go anywhere. Welcome back. You're watching Investors Guide and ET Now. Thank you so much for staying with us. Narendra Kumar is still with us in our Delhi studio, and we're reviewing our portfolios. Now, we designed these portfolios 5 years ago when we started the show, and we've been tracking them ever since. We talked about the ones designed for a 25 and a 35-year-old. Let's now talk about our stable growth portfolio. It was designed for a 45-year-old. The idea was to give you stable returns while, of course, helping you beat inflation and make money over the long term. Now, we started this portfolio in June 2009, and we've been investing 10,000 rupees every month, which means we've accumulated 6 lakh rupees in this portfolio. Its current market value is 9.41 lakh rupees. That's a total profit of 3.29 lakh rupees and returns of 17.38%. Narendra, this has always been my favorite portfolio. 4 balanced funds, really simple, easy to manage. And we noticed when the market was doing badly over the last 2 years, this portfolio beats the other portfolios that were meant to be more aggressive. And now that the market has recovered, it's still doing better. Tell us what makes this portfolio so stable.
Yes, in fact, it is. Of course, things will change in future because, in struggling times in the last 5 years, the stable growth portfolio delivering more return than our aggressive portfolio, which is 90% equity and 10% fixed income. Compare that with, this is about 65 to 70% into equity, remaining into fixed income, and that too structured in a manner that there is absolutely no tax incidence. So even here, the return of nearly 17.5%, which is little more than the growth portfolio as well as the aggressive growth portfolio. I would say that the indiscipline with which some of these balanced funds are managed, compared to the expectation of an individual balanced fund investor, that has heavily contributed to this performance. And I think that is likely to prevail because, balanced funds are not sold on its stability, but it's sold on growth. I think the rebalancing bit which happens internally in the fund has contributed heavily to this outperformance.
Right, this portfolio has been one of our most successful portfolios. Remember, again, designed for a 45-year-old who's nearing retirement, who wants stable growth, doesn't want the ups and downs of the market to affect his money as much. 4 funds in this portfolio: the Candor Robeco Balanced Fund, HDFC Prudence, ICICI Prudential Balanced, and the Reliance Regular Savings Balanced Fund. Let's move on to our conservative portfolio. Again, this is a portfolio we started in June 2009, designed for a 55-year-old. Stable returns with capital protection. We invested about 6 lakh rupees, 10,000 rupees every month for the last 5 years. Current market value is a little over 8 lakh rupees. We've made a profit of 2 lakh rupees on this portfolio. That's a total return of 11.26% annualized. I'll give you a list of the funds in this portfolio. The FT India Dynamic PE Ratio Fund, the HDFC MIP long term, and the Reliance MIP. Narendra, I remember the last time we talked about it, you seemed a little unhappy with the way the MIPs were running business. You said it was too expensive for the kind of fund management an MIP offered an investor. Have you changed your view right now? Do you want to continue holding these MIPs?
If you want to have a low maintenance portfolio with some upside, ability to beat inflation with a small allocation to equity, this is the way to go. But the expense bit actually is quite disappointing. So for most large investors, I would suggest that they should put their money in a post office MIP, and some part of their money gets into an all equity fund. That way, if an investor is able to do that at his level, he'll be better off. With this portfolio, we are trying to, attain an allocation of 60% to fixed income, 40% to equity, and that too in a manner that the investor does not have to rebalance it every now and then. And from that standpoint, we have succeeded. Of course, I would have been, happier with lower expense, because if you look at this 11% return annualized, this return, if the MIPs were fairly priced or they were lower expenses, then this return will be about 1% more on an annualized basis, which is quite meaningful for an investor who is targeting such allocation and return.
Right, so our conservative portfolio was designed initially for someone who has a 5-year horizon. So you're nearing retirement, you want to keep your money safe. At the same time, you do want it to beat inflation. That's what this portfolio was designed for. I'll give you a recap of the funds in this portfolio. The Franklin India Dynamic P Ratio Fund of Fund, the HDFC MIP Long Term, and the Reliance MIP. If you have questions about this portfolio, write to us. Email ID is on your screen. Coming up after the break, of course, we're going to talk more about portfolios. We have a low-cost portfolio that we want to take a look at. And of course, the portfolio we designed for our retired viewers. That's on the other side as well. Don't go anywhere. Welcome back. You're watching Investors Dive in ET now. Thank you for staying with us. Now, Narendra Kumar is still with us in the studio. We talked about portfolios that were designed 5 years ago for young, aggressive investors. We also talked about our stable portfolios designed for 45 and 55-year-olds. And these are our portfolios that were designed for our retired viewers. The first of the two is our income growth portfolio. Again, it was started in June 2009, designed for a 65-year-old. The idea behind this portfolio is a little different from the rest of us. You were meant to have first invested in the senior citizen savings scheme. This is over and above that investment. It's a secondary income. The idea is to help your portfolio beat inflation. So we assumed that we would invest 10 lakh rupees in this portfolio. We would withdraw a certain amount of money every quarter so that it gives you that little extra return. It's given us a total return of 11.27% annualized every year for the last 5 years. Narendra, again, this was a different portfolio. The idea was different. It was a secondary income. It was meant to beat inflation. 11.27% does beat inflation. Are you happy with what it's done?
In a limited way, it has been able to achieve its results. But it is not at all very comforting, because this portfolio did assume a risk. There is another way of looking at this portfolio, because when a retiree invests all his retirement savings, one is normally into or heavily or substantially into fixed income to derive periodic regular income. This portfolio was designed in a manner that you are deriving less periodic income, and you are assuming risk, and even the capital is expected to beat inflation. The worth of capital is, despite the periodic withdrawal of nearly 7-8%, I was expecting that it should still be able to protect the worth of capital, which to an extent it has been, because the differential, if this portfolio is delivering 11.25% return and 8% is your annual withdrawal rate, so 3.5%, 3.25% is the inflation, is still your capital accumulation or leftover capital, which is not high, because it is not able to beat inflation, and that was my expectation. So it has, I would say that this is satisfying given the environment, but it is not achieving the initially planned objective.
So, Narendra, would you like to then make some changes to this portfolio, or do you want to watch it for a little while longer and see how it does?
No, I don't see any reason to actually. I can attribute all this, relative underperformance or its inability to be, achieve the results entirely to the equity market. And I did not expect that equity market will just move, refuse to go anywhere, even with these funds. My sense is that I think, as equity performs, the underperformance will be more than recovered in years to come.
All right. So remember, the idea behind designing these portfolios when we did 5 years ago was to test out the hypothesis and to actually show you that when we give you advice about investing regularly, when we give you advice about putting your money in a certain type of allocation, we can actually illustrate that advice through this portfolio. So we're going to watch this portfolio a little more and see how it does as the equity market recovers, which you're expecting it to do over the next few years. I will give you a recap of the funds in this portfolio. There's the FT India Dynamic PE Ratio Fund, HDFC MIP, Reliance MIP, and the UTI Balance. This was designed for our retired viewers. The idea is you invest in the senior citizen savings scheme as much as you can, and then you put the remaining money in this portfolio to beat inflation. One last portfolio to look at before we wrap up the show. This is our low-cost portfolio. It was started in January 2010. Now, the total cost of this portfolio is a little less than 1%. You have to remember, a normal mutual fund will charge you a little more than 2%. So you're saving about 1% on this portfolio simply on charges. The idea is, whatever you save on charges, you make up for in returns, because that automatically translates to returns. We've invested about 4.8 lakh rupees in this portfolio. Current market value of that 4.8 is 6.8. So we've made about 2 lakh rupees. Narendra, that's close to about 15% completely tax-free on this portfolio. There are two funds. There's the Goldman Sachs Nifty Bs and the Goldman Sachs Nifty Junior Bs. So, are you happy? Was this what we were attempting to do with this portfolio?
Yes, this proves the point that low-cost investing works, and it has been able to achieve the desired results. But if you compare it with, 17%, 18% return, which is achieved on our growth portfolio, that actually proves and demonstrates one thing, that indexing is still, that we still haven't come to a stage, or the Indian market is still not at a stage where indexing has a very compelling case. Active management still rules. Good fund managers still, handsomely beat the index by a wide margin and fairly consistently. And also the breadth of the market, my sense is that Indian market is very broad, though not very deep. And from that standpoint, the fund managers who assume risk selectively, and their understanding or knowledge or selectivity can cause a huge difference in performance. And this is what our index fund will not reflect. So the 2% underperformance despite its lower cost, which means that a portfolio of our kind with 10-20% allocation to fixed income is also able to beat it.
So then the hypothesis, Narendra, that if we save 1% on return, that should translate to higher returns. Of course, when we said that, it was keeping in mind the fact that you have to have a very long-term horizon, and we've only had this portfolio now for 4 years. Do you think we should hold on to it the way it is and see how it plays out?
Yes, I think, this portfolio was primarily designed that, there are investors who can't choose the fund. There are investors who think that, they should be investing in index funds only, and index funds only to save cost. So in that sense, it is partially able to achieve those goals. If you want to be passive, this is the way to go, and it is getting pretty close to the actively managed fund. But yes, the case for actively managed fund is still very strong and compelling.
All right, so this is our low-cost portfolio. There are only 2 index funds in this portfolio, Goldman Sachs Nifty Bs and the Goldman Sachs Nifty Junior Bs. SIP running in this portfolio. We'll, of course, track it, especially designed, like Narendra said, for those of you who don't want to go through the trouble of having to pick a fund and bet on one particular fund manager. This is the index that will move with the index. If you have any questions at all about anything you heard on the show today, write to us. If you want us to send you a list of the portfolios, we'll do that as well. And of course, Narendra, thank you so much for spending time with us this week and answering all of our questions. Thank you for spending time with us for the last 5 years.
Thank you.
All right. Before we let you go, I want to remind you one more time, if you can shoot a video of yourself on your cell phone telling us about how the show has helped you and what success you had with your portfolio, send it to us on our email ID, Facebook or Twitter. Especially if there's a woman investor who'd like to get in touch with us. We're always open to hearing from you. We'll give you a big prize at the end of our 275 episodes for the person with the smartest portfolio. Tune in next week to catch the show. Thanks for watching.